Another interesting factor, perhaps, apart from the low interest rates, that also might have an impact on how you see equity valuations, might be the risk of inflation. And in fact, I was listening to some of your other interviews you have been giving in the past 12 months or so, Alistair, and one of them where I came across is that you have been warning that or expressing concern that these huge stimulus packages, COVID stimulus packages being rolled out in the Western countries could really be a problem, because they have to be repaid at one point, or if not repaid, then maybe lead to potentially much higher inflation down the road. And now when I look at news headlines over the past months, there have been sort of more and more sort of signs here and there, or warnings here and there, that we might actually see indeed inflation picking up as a result of this. Now Asian countries to some extent have been a bit less aggressive in terms of these stimulus measures, including China, but the problem for I guess, but correct me if you see it differently, but the problem I think for some of the Asian countries will be that if we saw a devaluation and inflationary pressures in Western currencies to a more significant extent, then maybe the Asian countries will also be pressured to inflate a little bit as well, in order to still keep the exports machines to the Western countries humming. And so eventually, due to these processes, we might be perhaps seeing currencies globally seeing high inflation rates. Now, is that something you see in a similar way? Do you agree with that? And also, if so, and if that should come true, these higher inflation rates coming through, how are you positioned for that in your portfolio? Have you bought any position specific to that? Is it going to be beneficial? If it does it pose challenges? Any thoughts on that would really be great to hear. Thank you.
Yeah, sure. I mean, I guess the first point to make is that we're not macro or top-down experts. Dare I say, our skill is in identifying which companies, which management teams to back. That said, I think there's two parts to inflation. There is firstly the point that you mentioned, that central banks have been printing money. And the big difference today compared to the global financial crisis is that today that money is going into consumers' hands. It's going into small and medium enterprises, it's going into individuals, whereas in the global financial crisis, the money that was printed went to shore up the banking system, and that didn't lead to any pickup in money supply. And what you're seeing in the developed world is massive growth in money supply levels, unprecedented levels. So that in itself is a warning sign that inflation could pick up, and it's one of the reasons commodity prices have been picking up as well. The second point is much longer term, and I think is probably less people are talking about this, and that is, if you look at the last 40 years, you've seen disinflation or certainly disinflation, particularly around wage growth. And the reason for that is you had China, and a lot of manufacturing moved to China. You had the fall of the Iron Curtain, and you also had the opening up of the Eastern European economies. And all of that meant that high wage growth countries exported that labor to low wage countries. And that now is coming to an end. It's coming to an end because China is now not a cheap place to manufacture, number one. Number two, there is a rise in nationalism, and that's, we suspect, over the long term going to, and obviously populations are aging, and as populations age, a lot of the workforce goes into looking after the elderly, and so therefore wage pressure, even though unemployment is going to pick up when furlough schemes end, it's something that we're a bit concerned about. We tend to be concerned about things that we haven't seen for a long time. So only those of us working in the 1970s, and I wasn't, but inflation really ended in the early 1980s. So a lot of people haven't worked through an inflationary environment, and this is going to be the big challenge. Now, Do we manage our portfolio because we think inflation is going to go up? No. Do we consider these factors in terms of when we're assessing what the downside risk? Absolutely, yes. So if you look at the St. James's Place Asia Pac portfolio, it is focused on the larger companies in the universe. By nature, that means that you tend to see companies that are naturally strong because of their size. A lot of companies operate in oligopolies. So, for example, our Australian healthcare companies, CSL and ResMed, operate in industries where there's only really 2 or 3 players in most areas. The second thing is the companies that we're investing in on the whole have very high gross margins. And what that means is they have an ability to pass on any inflationary costs.
Are you concerned about levels of public debt? And equally, how do you see that impacting potential recovery?
Best economists talk about how do you solve a debt crisis. You either, one, live within your means and you have austerity, which is politically unpalatable, as we've seen in Europe. Number 2 is you default on that debt. But if your debt is in your own currency, you can't really do that. Number 3 is you inflate your way. And it's absolutely what central banks want. They're not going to publicly say it too loudly, but the best way is get inflation and inflate your way out of that debt. And that's, as Martin was alluding to, that's what we believe very strongly is happening.
I suppose while there's sensitivity to rising interest rates, on the other hand, perhaps to some extent, and partly that was also what Warren Buffett seemed to be alluding to a little bit, is that actually when you do own quality companies that do have an edge in the market, there may be a good chance that those companies can actually pass on rising input costs, if they should be sort of sustained and kept going up, to
Martin, it's such a good point. You know, you want to have businesses that have pricing power, and we have fabulous pricing power. Let's take McDonald's, for instance, you know, and people are scared about, you know, commodity prices going up, you know, chicken prices and meat prices and things going up. Let's say they go up 10%. The commodity prices in terms of making a Big Mac or something, the cost of goods sold is around 30% of revenue. So if commodity prices across the whole of making a Big Mac goes up by 10 percentage points, they need to recover 3 percentage points of price rise to offset a 10% in their cost of making that the hamburger, because typically their rent and things isn't going up like that, but those commodity prices. We have a great degree of confidence that McDonald's, plus probably some productivity savings, can put their prices up 2 or 3% to offset a pretty sharp increase. And that's what we like. We want businesses that actually have the ability to pass it through to make sure that our earnings are protected.